Number 7 on our list of the top 10 insurance issues for non-insurance lawyers is post-acquisition and merger insurance and insurance-related issues. So what we have here is, and this is really sort of part of our advisory services that we have here at Miller Friel, we have Company A purchasing or acquiring Company B. And what happens is, very important in this transaction, is that Company B, the acquired company, its policies will end at closing, right? And let's just focus on the directors and officers insurance, because that really is the big focus for the individuals involved with the transaction, because it affects them personally in terms of coverage. So their insurance as the acquired company basically ends the day of the closing. And then they either go on as employees with the surviving or the acquiring company, or they take maybe a cash payout and go on, their merry way. And then the acquiring company has its continuing insurance, where it then adds its employees or new officers under its insurance policy, and it's going forward. Here's the issue. What happens 6 months after closing? A lawsuit is filed, and the lawsuit alleges wrongful conduct by one of the officers in the acquired company pre-closing, right? 6 months before closing, that person or a group of people did something, and now it's 12 months later, right? You had your closing, 6 months, and then 6 more months, a lawsuit's filed. The new acquired company and its policies don't cover pre-closing wrongful acts, right? The acquired company's policies had terminated at closing. So you want to make sure, and this is what we work on, is that the insurance that's expiring, right, that's terminating, has what we call runoff insurance, or extended reporting period, which means, very simply, that expiring insurance doesn't cover any new wrongful acts. It covers old wrongful acts, but when the lawsuit isn't filed for 6 months after closing, or 1 year after closing. And you could do it up to 6 years. We've seen it as long as 6 years out. It's very expensive. You have to pay an additional premium, but for any officer or director of an acquired company, you want to negotiate very, very hard to get the longest discovery or runoff period of time as possible. A minimum of 1 year, but you really want to try and get at least 3 is our recommendation. So that's one example of where that comes in, and that is something we work a lot on in terms of advising in advance as part of that transaction. The second area where this will come up is, and it just came up with one of our clients about a year ago, is our client is a large pharmaceutical company. It purchases a smaller pharmaceutical company. It's exactly what I just said. One policy terminates, has a runoff period. The acquiring company's policy continues in force. A lawsuit is filed for pre-closing wrongful acts. Here's the wonderful thing. The acquiring company typically is the larger company. Larger companies typically have larger insurance policy, larger limits, bigger programs. They also have higher what we call deductibles or self-insured retentions. It could be $500,000, it could be $1 million, it could be even more than that. We have some financial institution clients with a $100 million deductible or SIR, self-insured retention. Those deductibles or SIRs can be very, very difficult to exhaust. You may have a claim that comes up where all the costs incurred, legal fees, maybe even settlement, are all within that deductible or SIR, and you never get to the insurance, right? Here's the beauty of having that runoff policy. The acquired company that's gone away, it's been acquired, typically is your smaller player. Smaller policies, smaller limits, and you guessed it, smaller deductibles and smaller SIRs. So instead of a $10 million SIR, maybe you only have to deal with a $50,000 SIR. So if you can tap into that policy because you've extended that reporting period, that runoff period, you're going to get access to a policy oftentimes with a smaller deductible or SIR where you can get those insurance proceeds quicker and faster in terms of accessing it and funding your litigation. And that's a very, very important feature of those policies.